Michael O'Brien. I'm a fund manager of the Fundsmith Emerging Equities Trust. I'd like to thank you for your time for watching the presentation I'm about to talk you through, followed by questions and answers. Firstly, we need to spend a few seconds to digest the disclaimer, which by law we have to show you. So moving on to page 2, for those who don't know the trust, I think it might be worth reiterating why we did set up the trust in 2014. The genesis of the investment trust lies in the investment opportunities inherent in emerging markets. These were apparent from the early days of the Fundsmith Equity Fund, which was launched in 2010, when it became clear that one of the biggest growth drivers, if not the biggest growth driver, to most of the companies in that fund was actually emerging markets. FEAT is focused on attractive demographics and growing spending power of middle-class consumers in developing countries. Simply put, that involves more people, those people getting richer, and that in turn leading to increased consumption and changing tastes. The fund was set up as an investment trust due to a combination of high volatility and lower liquidity in emerging markets, meaning that it was not compatible with becoming an open-ended fund structure. And above all, FEAT shares the same approach as a Fundsmith Equity Fund, both in terms of the three-step investment process and the characteristics of the businesses in which we invest. So what is a three-step investment process? Apologies if you've seen this slide before, but it is worth recapping as it is the heart of everything we do. Firstly, we buy good companies. Second, we don't overpay. And thirdly, and probably more difficult than anything else, we try and do nothing. So what makes a good company? To us, there's basically 4 facets. The first is quality. We look for businesses which have high returns on operating capital employed in cash. Second, the ability to grow these returns driven from the reinvestment of their cash flows at high rates of return. Thirdly, we look for businesses which make money from a large number of everyday, small ticket, repeat, predictable transactions. And fourth, sustainability. By this, we mean the ability of these businesses to protect their returns against competition. And if you look at what this means for the metrics of our portfolio, FEAT has a return on capital were the fund actually a company of 40% compared to the index of 11% and the Fundsmith Equity Fund of 25%. The gross margin at 52% is higher than the index at 33%, although lower than the Global Equity Fund at 65%, largely because, unlike the Global Equity Fund, there are a number of retailers within the Emerging Equities Trust. Operating margin at 18% compares to the index at 11%, and cash conversion of 93% compares to the index of 82%. I think more importantly, as investors in the trust, you should look at the free cash flow growth. Although I would caveat that these are historic numbers, as of the 31st of the 12th, 2020, the fund had a historic average cash flow growth of 21% for the previous year, compared to 8% for the index and 8% for the Fundsmith Equity Fund. So what does this mean? The process we operate and the companies we invest in as a result leads to a concentration in certain sectors of the market. This is effectively an outcome and is based on the 4-step criteria we look for in selecting companies I've outlined on the previous slide. Hopefully this helps to explain why the fund is so different from the index. Our active share is approximately 94%. In terms of the sectors the fund is weighted towards, again, this is an outcome, not a deliberate choice, but sectors we typically invest in are consumer staples, healthcare, IT, consumer discretionary and industrials. We are highly unlikely to invest in financials, communications, materials, energy, real estate and utilities, largely because across these sectors you have a combination of low returns, asset intensive businesses, cyclical businesses, business models which require leverage to get returns, regulatory risk or regulated returns, and the risk of obsolescence. The second step of our three-stage investment process is don't overpay. When it comes to looking at a company and valuing it, we look at the free cash flow yield of a company and assess it in the context of the sustainability of that company's competitive advantage and the longevity of growth prospects. If we look at, again, the historic numbers, as of the 31st of December 2020, the cash flow yield for FEET was 2.5%, significantly dearer than the index at 3.6%, but as we will see later in this presentation, to us, the FEET portfolio is significantly higher quality than the index. We would also point out that FEET is slightly more expensive on this metric than the global equity fund, but as I mentioned earlier, the free cash flow growth from FEET is significantly higher at this point in time than it is for the global equity fund. And the third element of the process, and potentially the hardest, is do nothing. What do we mean by do nothing? Well, firstly, it's relatively simple. Our ideal holding period is forever. I know it sounds flippant, but the logic lies in the trends that the fund is trying to capitalise on. If you think that as an emerging market investor, you are investing in countries with significant population growth and economic growth, your ideal holding period is actually going to be multi-generational. We will only exit a position in one of four circumstances. First, where management makes bad capital allocation decisions, that's typically poor strategy and quite often revolves around an acquisition. Second, where there's a fundamental reappraisal of the investment case. This is typically caused by regulation or where a firm's competitive position has deteriorated. Third, where the valuation becomes indefensible, and even if the stock becomes very highly valued, we are not likely to rush to sell it because to us, we are, again, as I stress, long-term investors. And fourth, where we've identified a superior investment opportunity. Some portfolio turnover will be involuntary, for example, in the event of a takeover. It's probably worth reflecting on the fact we've only seen 2 takeovers since the launch of a fund. To us, that reflects that the businesses we own appreciate the long-term opportunities open to them and are not at a point where they believe there is value to be garnered by selling it to a rival business. So if we move on, looking at performance. If we look at performance, 2020, I'm pleased to say, was a very good year for the fund. We outperformed the emerging market index both from a share price and an NAV perspective. And in the first quarter of 2020, where markets took fright as the coronavirus outbreak began to spread globally, we had a very, very strong period of outperformance on a relative basis. In 2021, the first quarter was impacted by rotation into value stocks from growth stocks. As you will notice, from what we say, we are not value investors. And also it's worth noting that for every week in the first quarter of 2021, ETF fund flows, which drive the index, something which our fund is not particularly correlated, were positive in every single week. In terms of what's happened since the end of a quarter, although we are not fixated on short-term performance, the fund was up just under 2% in April against an index up just over 2%. And in May, as we speak, we are currently approaching 300 basis points ahead of the index for the month in terms of relative performance. What are the big drivers to relative performance? As I've intimated, we have significantly different geographical exposure and also sectoral exposure to the MSCI index. And we also, as a result of that, have a markedly different currency exposure to the index. If you look at where the fleet portfolio is, 43% of the fund is invested in India. That compares to the index, which at the end of 2020 was 39% invested in China and Hong Kong. In addition, South Korea and Taiwan, between the two countries, account for over a quarter of the index breakdown. As we said at the time of the launch of the fund, we are unlikely to invest in South Korea or Taiwan, largely because to us, those countries have both the demographic profile of the developed country, and they also have a GDP which is not dissimilar from Western countries. The difference obviously between FEAT and the index, therefore, or the biggest one, is India as against China. Again, this is an outcome from our four-step investment process. Setting aside governance, legal and returns issues we find quite often in Chinese companies, India is a repository for very good FMCG companies, both on a national and a regional basis, and has more attractive demographics than China. Both of these factors to us make the India exposure relatively straightforward compared to being able to find a significant weighting of companies operating in China. Behind India, you will note that our China exposure is about half of that of the index. And I would point out that the 9% for Argentina isn't actually Argentina per se, it's actually a business called Mercado Libre, which is based in Argentina, listed in the US, but its main country of operations is actually Brazil. So following on from how the fund differs geographically from the index against which we are compared, it is worth looking at it on a stock-specific basis. The fund is on the left-hand side, the index is on the right-hand side. First, you will spot there are only two companies in the top 10 holdings in the index which we actually own. Second, you will notice that the average return on capital for FEAT as of the 31st of December 2020 at 43% is significantly higher than the 10% for the index. And you will also note that FEAT, with the top 10 holdings contributing 48% of the fund, is significantly more concentrated than the MSCI index. So if we move on, for those who have been following the fund since inception, you will be aware that the day-to-day management of the fund changed in 2019. I think it's probably a good point in time to give an update on how the portfolio has progressed since that point almost 2 years ago. There was 4 themes which we identified as perhaps having held back the performance of the fund. And over the last 2 years, which I'll touch on the next slide, we think we've made a number of steps, most of which are now largely behind us, in 4 areas. First, macro and political risk. We've reduced the exposure to countries with relatively high macroeconomic and political risk, particularly in frontier markets. To us, this was hindering performance through a combination of illiquidity and, I think more pertinently, currency devaluations. If you're running a fund where the stock prices are going up, but you're fighting headwinds of currency devaluation, it is obviously going to impact performance. Second, sector diversity. The fund remains an FMCG focused fund. Over half of the NAV is invested in FMCG companies, and that, as you will be aware of, is the genesis of the fund. However, we have increased the weightings in healthcare and technology companies, of course having to fit our very strict criteria, in a view that the fund may perform better in up markets whilst maintaining the defensive qualities on the downside. Third, in the area of ownership and governance, we've decreased our exposure to listed multinational subsidiaries and placed a greater emphasis on investing in businesses with more entrepreneurial and incentivized management. That doesn't necessarily mean we've sold all the listed multinational subsidiaries we own. In fact, 2 are actually in the top 10 holdings of the fund. What we have found is there's effectively a dichotomy between good multinational subsidiaries, where typically you have local management who know how local markets work, and bad multinational subsidiaries where you have unincentivized management, typically coming in on short-term contracts from the overseas parent. And the fourth area we've focused on is portfolio concentration. We've increased portfolio concentration largely because we take the view that we should have the strongest conviction in a smaller number of companies. So how has this manifested into the portfolio? If you look at December 2018, 12% of the fund was in frontier markets. That's now down to 7%, and almost 3% of that is in one company in Vietnam. Sector diversity, consumer at the end of 2018 was 81% and technology just 5%. As of the end of December 2020, consumer is 64% and technology is 20% of the fund. Healthcare over the same period has increased from 14% to 16%. The percentage of the portfolio in family or founder influenced companies has increased over the 2-year period from 53% to 76%. And the number of holdings as of the end of December 2020 was 38, down from 45 at the end of 2018. We currently have 36 holdings. We suspect that even in spite of the policy change which the AGM has approved, a lot of the biggest shifts of emphasis have now been made. I think before opening the floor to Q&A, there's 3 further developments I would like to touch on. Obviously, 2020 is a year which is going to be forever associated with the coronavirus outbreak. In terms of what has been the impact of COVID-19 on our portfolio, to be brutally honest, many of our companies have benefited from the pandemic. There's been a global change in emphasis from efficiency of supply chains and having efficient leveraged balance sheets to business resiliency. We are very well placed to benefit from that. Second, social, economic and political change tends to have a bigger impact during and after a pandemic. You're probably looking at maybe 20 years of change in areas such as digitalization now taking part in maybe a 5-year window. It's clear to us that this acceleration is already happening. We see 3 trends coming from the acceleration: market consolidation, formalization of the economy and digitalization. All the businesses we own, we believe, are well exposed to these areas, and we would again point out that the portfolio demonstrated resilience during the outbreak given its exposure to defensive sectors and high quality companies, as witnessed by the 2020 performance both on an absolute basis and relative to the index. We believe that the portfolio is very well positioned going forward to benefit from the trends which COVID is both throwing up and accelerating. Second, I think nowadays you cannot do an investor presentation without touching on ESG. ESG is clearly becoming of increasing interest to investors, so I will touch on the role of ESG in our investment process. Above all, as long-term investors, ESG is an integral part of our investment approach because we are concerned about the sustainability of a company's business model. We approach ESG by taking into account all the factors that may impact the sustainability and longevity of returns for a business into the future. This leads to positive ESG investment outcomes. First, if you look at the environmental impact, our process leads us to avoid asset-intensive, low-return and cyclical businesses, automatically barring environmentally destructive industries from feet, such as agribusiness, oil and gas, resources, heavy industries and cement. From a social point of view, the vast majority of the businesses we own have brand values and public perception to protect, which leads to positive social outcomes. And in the area of governance, governance is a material element of our evaluation of candidates for our investable universe. Simply put, we don't invest where we find governance structures or policies to be unsatisfactory. It is worth pointing out that we vote on all proxies we receive ourselves, and we regularly engage with management on areas as broad-ranging as ESG, remuneration, business performance and innovation. Fundsmith, of course, are signatories to the UNPRI, and the trust managers sit on the Fundsmith Stewardship and Sustainability Committee. Moving on to outcomes, in the interest of time, I won't label these examples, but they are not unique across the fund, although for emerging markets as a whole, I'd like to point out that data is variable and patchy. But here we have 4 examples of businesses where we believe they are well placed from an ESG point of view. Mercado Libre, because it is driving the growth of financial inclusion in Latin America. InfoEdge, because it has very strong governance, although I hasten to add the vast majority of the companies we own would have very strong governance, and the balance would be what I would call good to very good governance. Stakeholder management, Marico is an Indian hair oil producer. It has gone out of its way to help develop the supply relationship with small farmers in India, which has helped them transform their businesses and their economics. And the final example is Vitasoy, a product you may be familiar with in UK supermarkets, but it is a Hong Kong-based business which sells plant-based food and beverages. You will notice from the comments on the box that Vitasoy has made great strides in terms of building a sustainable business model. And the third element and final element to touch on before we move to Q&A is you will note that the proposed changes to investment policy were passed at the AGM. To us, it's evolutionary rather than revolutionary and is a natural progression reflecting both the economic and capital market development of emerging markets. To us, the change basically allows the fund to invest in areas which we believe will be advantageous to shareholders, not deviating from the main focus on economic development of emerging markets, but at the same time broadening it to move it marginally away from being a solely consumer-focused mandate. And also we have approved a reduction in the number of stocks from 35 to 55 to 25 to 40. As I said, we currently have 36 stocks. And if we turn over the page, the main reason for the increase in portfolio concentration is that we want to invest in companies where we have the strongest level of conviction whilst ensuring sufficient diversification and risk management, which is in line with operating in emerging markets. Going back to the policy change, we see it as an evolutionary next step, which will allow the fund to benefit from changes in emerging markets such as human capital development and the growth of industries such as healthcare, services and software. This is a consistent approach with other funds within Fundsmith and increases the scope and range of investment opportunities. And above all, I will stress it will not lead to a change in approach or compromise on the quality of the companies we invest in. So in conclusion, the aim of buying good companies, not overpaying and then doing nothing remains unchanged. The portfolio evolution continues and now has a greater focus on businesses operating in environments conducive to sustained growth. The investment policy change brings consistency across funds within Fundsmith and increases the scope of potential investment opportunities. COVID-19 has accelerated existing themes around market consolidation, formalization and digitalization. Despite ongoing disruption, which continues to this day, the portfolio, in our view, remains highly resilient. And finally, our long-term approach focuses on sustainability. I'll take this opportunity now to open the virtual floor to questions and answers.
Has the return on capital been consistently high for our portfolio companies? And if so, why does that not tend to reflect in the share price over the long term? Given FEET is now approaching 7 years old, I would have thought that that was a long enough period of time. Or have other factors significantly negated the impact? And if so, can we take a view on whether things are likely to change in the next medium to long term period?
Okay, probably more than one part of an answer to his question. I think firstly, dealing with return on capital, if you look at our process, we continue to seek very high return on capital companies. So that has not changed. I think probably the biggest element of the whole issue of quality is actually the ability to align quality with growth. A high return on capital may be one thing, but if you look at the past performance of stock markets, typically it's the ability of a business to grow that is the major determinant of a share price. I think second, in the context of FEET, what you have is that you can have growth, you can have quality, and you can have share price appreciation. But if you are operating in markets, or rather countries, where you have ongoing currency weakness, it will also negatively affect returns. Hopefully, if you look at how the portfolio has evolved over time, and particularly in the last couple of years, I would take the view that going forward, it's certainly at least as well positioned to benefit from these trends as it has done in the past.
Thank you. How worried are you about the regulatory outlook for tech stocks in China?
Okay, good question and very topical. First, I think it's fair to say we can't second guess regulators, and that's anywhere in the world, and particularly, I think, emerging markets relative to developed markets. I think in terms of China, it's a very difficult regulatory process for investors because the regulatory process has limited appeal rights, is often driven by political motivation, and to us it's clear that risk has increased, but at the same time the companies we've come across, and certainly ones in our portfolio we own, are working hard to mitigate it. I think firstly, one comment I would make is we always consider regulatory risk in our investments wherever they are in the world. And I think second, in a Chinese context, you certainly have to invest with Western standards of governance and risk management than local ones. Where we have invested in technology stocks in China, we have typically avoided businesses where we think the founders or the business model would antagonize the authorities. The prime example being we have never owned Alibaba, and if you look at what's happened to Alibaba over the course of the last 9 months, following its decision to demerge and then the subsequent blockage of the Ant Financial IPO, I feel like we have been vindicated. But at the same time, definitely risks are increasing. I just think the businesses we own are able to manage those risks.
What do you look for in corporate governance when you're evaluating an investment?
Well, simply put, as much as we can. And it goes without saying that if we are not comfortable, we won't invest. In terms of our process, when we look at businesses for inclusion in our investable universe, we look at the history of the founders, their integrity, the culture of the company, board structure, incentivization, and related party relationships. We also look at shareholder structures and elements of things like ownership, or whether there are discriminatory voting rights against non-founding shareholders. And as a point aside, one of the things I like talking about is actually some of the things we've seen which we've not invested in. And for example, 3 businesses we've looked at since inception of the fund, which we decided not to include either in the investable universe or the portfolio. One was a business where you had a husband and wife team as chief executive and finance director. I can't imagine the finance director asking too many probing questions of the chief executive in those circumstances. The second one was a Thai company where the board all bought shares in another listed company shortly before they made a bid for that company. And the third example was, and we've seen more than one example, where the directors of a listed company own the main distribution partner for that company and effectively use the listed vehicle as a bank for their own personal ambitions.
In your reporting accounts, you talk about formalization, consolidation, and digitalization. I understand digitalization, but what exactly do you mean by formalization and consolidation?
Again, good question. Formalization refers to more transparent supply chains and a move towards products made in a clean, hygienic environment. I guess probably another word for formalization would be professionalization. The prime example to us would be, say, in somewhere, a country like Pakistan, the vast majority of milk is sold loose in market in plastic bags. Formalization would mean that over time, that milk is produced professionally, carried in a cool chain environment to a supermarket or a convenience store and sold in a fridge or cold environment. Why that is important is generally what you find is pandemics or food scares lead to an acceleration in formalization. In terms of consolidation, I think that's probably more obvious. It's simply larger players getting bigger. They have access to capital, they have strong distribution networks, and they have very intense supply chains that allows them to capture share at the expense of weaker rivals.
I've been to Vietnam on holiday and was surprised how vibrant a country it is. Why is there only one Vietnamese stock in the fund?
Okay, yes, we own Vietnam Dairy, which is the biggest company in Vietnam. We have looked at other companies in Vietnam, and there is one which is in our investable universe which we do not own. The problem we have with Vietnam is the capital market is very embryonic. It's still a frontier market. There's a large element of government control and government ownership in the country, and a lot of businesses in Vietnam are conglomerates, which are by their very nature businesses we typically don't like.
You recently made an investment in Taiwan. Why has it taken you so long, and do you anticipate there to be more?
Good question. We bought a business which, if you'd have asked us at the start of the fund 7 years ago, would we own, we would have probably said no, but we got comfortable with it. It's a business called Taiwan Semiconductor. It's a global supplier. It is probably, I think, simply one of the best businesses we've ever seen. In terms of other opportunities in Taiwan, I think it's quite limited. First, Taiwan, however great a country it is a country of just 20 million people. So it's a relatively small market. That means that a lot of Taiwanese companies in areas such as consumer goods or leisure have to go overseas, typically to the mainland, to develop their businesses. What we've seen in a number of cases is where there's some form of retribution on behalf of authorities in mainland China against Taiwanese companies. It becomes very easy for boycotts and things like that to be launched, and obviously that's got pretty severe detrimental impacts on potential investments we could own in Taiwan.
You've increased the weighting in healthcare over the last 2 years, but I noticed that you do not seem to have invested in hospital stocks or biotech businesses. Why is this? And as I thought, both would be attractive sectors in emerging markets. Okay,
yeah, and there are a huge number of listed hospital companies around in emerging markets. We've not invested because typically to us, they are very asset intensive businesses. They are expensive to run. Doctors don't come cheap, and typically are priced on almost an international market. And the other issue you have is the government is almost a monopoly buyer in most cases for hospital companies, which to us makes it across the board a relatively uninteresting and unattractive business model. In terms of biotechnology companies, you obviously have risks. Not only do most drugs not make it to commercialization, but you also have regulatory Darwinism on the way through. So effectively, to invest in biotechnology, you're committing money for a rather uncertain outcome.
In the results statement, you comment that you have sold TravelSky due to capital allocation concerns. What exactly were these, and is it a warning for other Chinese stocks you own?
Okay, TravelSky is the only time we held a state-owned enterprise. We're well aware of the risks when we bought the stock. Control was delegated to a combination of the Chinese state and its airline customers. We liked the business model. It had a relatively low value, high repeat, high frequency ticketing model. Well, what put us off really was the decision the company took, and we think largely at the behest of the Chinese government, that it was to invest some of its surplus capital into, I think there was an insurance venture, there was a financial stroke wealth management venture, and there was a mobile telephony venture. That may be fine for TravelSky, but it's certainly not how we would look at businesses allocating capital. As a broader point, are we likely to ever invest in a Chinese state-owned enterprise again? Probably not, but I also think it brings a wider point. And if you go back to what I said in my presentation, I think that Chinese companies generally are not great allocators of capital. They get distracted too easily into things like vanity projects, which may be fine for the altruism of the founder, but it's certainly probably not a great idea or of great benefit to outside investors.
Please, can you discuss in more detail some of the opportunities the investment mandate change will bring to bear?
Yeah, sure. But first of all, I'd like to stress that this is not revolutionary. It's evolutionary. It aims to capitalize on sort of changes in the growth trajectories of emerging market economies, and also probably to a greater extent, the development of their capital markets. We would expect opportunities to arise largely in areas such as IT, software, and services. These are no different to where other Fundsmith businesses, or rather Fundsmith funds, have invested over time.
It would be useful to understand how the fund is positioned relative to its benchmark in relation to ESG.
I sort of think if you go back to the presentation, you will note that there was almost the wheel of the sectors we invest in and the sectors we are highly unlikely to invest in. And that probably shows how we are relative to a benchmark from an overall perspective. I think from an ESG perspective within that there was, as I said, a large number of industries, whether it be oil and gas, whether it be mining, whether it be heavy engineering, cement, where we simply won't invest or are hugely unlikely to invest ever, just on the basis they are asset intensive, low return, cyclical businesses.
As with the Global Equity Fund, the weighting in technology has increased. Do you want to talk about why and whether you think the sector is overvalued?
I think one of the reasons why goes back to the comments I've made about how capital markets have developed. I think I did the work at the year end of 2020, and I think we had 12 stocks in healthcare and technology. And I think only 2 of those 12 were actually listed at the time we launched the fund in 2014. So there's clearly greater supply. I believe that technology has become more embedded in life in developing countries. For example, if you go to a lot of developing countries, great emerging markets, you will find that people have almost sidestepped physical things like banks and have moved to online banking platforms, online money transfer businesses, online payment platforms. In terms of valuation, I think it's fair to say that hopefully you'd appreciate, but we are not buying business plan companies. We're buying established businesses, typically which are highly profitable and have strong cash flow to fund their own development organically. We've avoided what I would call some of the more bubble areas, such as AI and, for heaven's sake, things like Bitcoin. In terms of valuation, I think ultimately it's for the market to decide whether we've overpaid or not. I think if you look at the 3 companies we bought in the last 12 months, which are Taiwan Semiconductor, Tencent, and NetEase, all of those were purchased at valuations a lot cheaper than the average portfolio valuation for the fund. So to us, that gives me a relatively large degree of comfort that we haven't overpaid.
How has COVID affected your interactions with companies?
I think going back to the 3 factors which have come from the outbreak, digitalization has clearly made it a lot easier to keep in touch than it would have been maybe as little as 3 years ago. There's lots of video conferencing going on. A lot of companies have moved seamlessly into online forums. I think what we're probably missing as investors is, in a meeting with a company, you get to see the whites of management eyes. You don't get to do that on a video call. And I think as well, the other thing is, in a one-to-one meeting, people are probably more inclined to open up, particularly if you travel halfway around the world to go and see them, than they would be on a video call. I think probably the other thing I would say is you miss the feel for what's going on in the ground. For example, if you're walking around a supermarket, what's selling, what isn't selling. The great example I always use is if you're in Manila, if you spend an hour with a taxi driver stuck in a traffic jam, you'll get a totally different perspective to what's happening in the country than you will if you sit down with an investment bank's economist for an hour.
Do you plan to reduce the number of holdings further given the mandate change? And what are the reasons?
Reasons would be that we want to concentrate on the businesses we've got the greatest conviction in, which I think as investors in the fund you'd hopefully appreciate. In terms of where we're currently at 36 holdings. I think over time we may drift down towards the midpoint of the proposed, or the new rather, 25 to 40 range.
Will portfolio turnover remain elevated in the near term, given portfolio changes being implemented and the mandate change?
I think a lot of the changes we thought probably could be done 2 years ago have now been done. I would expect going forward, turnover or certainly new investment ideas will be on an incremental basis. We would certainly have to find something new which was better than something we already owned for it to go into the portfolio. So I think turnover will be slightly lumpy, but at the same time will actually be at relatively low percentage levels.
Given the second wave of COVID in India, do you have any concerns about the companies you own in the country?
Simply put, no, and if we did, we wouldn't own them. If you look at the companies we own in India, I think some of them across the whole of our portfolio are the best placed to benefit from the trends of digitalization, formalization and consolidation that we've outlined coming from the epidemic. If you look at where we are, I think probably we're at a point now where cases in India have plateaued. I think the great encouragement is, although it's pretty rudimentary, India has a pretty geographically expansive public health system which allows vaccinations to reach across the whole country relatively quickly. I believe the latest numbers I read, I think there's just under 200 million vaccinations being given out in India, and I suspect in the context of a developing country, India will be able to get shots into the arms quite quickly.